controversial stocks at the moment. It's got a loyal fan base of investors and customers, and skeptics and critics. The EV maker has been disrupting the auto industry with its innovative products. However, not everyone's convinced that Tesla can live up to its lofty expectations and valuation. Some even believe that Tesla's moment of triumph will be a thing of the past. Today we're going to explore a very interesting topic, and it's about how Jim Cramer may be playing a losing game when it comes to Tesla. This is what we mean. While Jim Cramer acknowledges Tesla's leading-edge technology and range of products that are bold, distinctive, elegant, and highly entertaining to drive, they have also pointed out that Tesla faces increasing competition, regulatory challenges, and operational risks. This is true, no doubt, but where Jim Cramer may be getting it wrong is that they also expect Tesla to lose market share and competitive advantage as more established automakers ramp up their EV offerings and catch up with Tesla's innovation. But could they be right? And why does Wall Street remain bullish on Tesla's market dominance and growth potential? Let's find out.
The world is evolving, actually, I think, even more closely to what we expected. Because we expected a lot of traditional auto manufacturers to see the writing on the wall and rush as quickly as they could into scaling big time into electric vehicles. And what has happened recently? Both GM and Ford have said, we're stepping back. We're not going to do this until it's profitable. The problem with that is, in order to be profitable, they need to scale. That's how this works. These are learning curves that they are riding down, and those are expressed in cost decline. So the fact that they're pulling back means there's more share for Tesla and others who choose to go for it.
And Kathy, I want to keep the conversation going on Elon Musk, but I want to bring it to the ARK Venture Fund. Of course, it's not an ETF. You invest in private companies, et cetera, in there. And you take a look at the portfolio, you have SpaceX in there, and you also have X, formerly known as Twitter. And in July, you had told the Wall Street Journal that you had written down your Twitter stake by 47%. Fill us in on the past couple of months. Have you written it down further, or how has that changed?
No, I think it's still there. We have to be very careful. This is an interval fund. It is a 40 Act fund, and we have to market every day. The good news is our clients can get in and have access to these amazing companies for just $500, and they get quarterly liquidity. So that's the good news. The markdowns are simply, if we see in the secondary market employee stock trading at a steep discount, we have to take that into account. If we see others in the more traditional asset management world, like Fidelity and others, marking their holdings down, we need to take that into consideration during our daily mark-to-market. So it's an abundance of caution. We have a 5-year investment time horizon. Do we think that's where X belongs in terms of valuations? Absolutely not. Absolutely not. A roughly $20-ish billion valuation for what we believe truly will become the everything app. Think WeChat Pay. Elon started his entrepreneurial career in the payments industry, and he's been thinking about this for a long time. He now has money transmitter licenses in more than half of all of the states, which we learned on Twitter Spaces, or on X Spaces, I should say, the other day when we had our interview with him. So that's exciting. He's going for it.
Jim Cramer is of the opinion that Tesla's valuation is too high and not supported by underlying fundamentals. And they also believe that the company's profit margins and cash flow are unsustainable, and that Tesla relies too much on regulatory credits, tax incentives, and stock-based compensation. That's not all. He also doubts that Tesla can achieve its ambitious goal of delivering 20 million vehicles per year by 2030 and become a leader in the EV and autonomous driving space, as well as with its battery tech and solar energy. There are many reasons why Cramer could be wrong about Tesla, and we're going to discuss them over the course of this video. Hey guys, welcome back to Tesla Tomorrow. Despite this bearish sentiment from analysts, Tesla has proven many skeptics wrong over the years, and has delivered impressive results and milestones. The automaker has a culture of innovation and experimentation, allowing it to constantly improve on its products, processes, and services. Tesla also has a first-mover advantage and network effect, giving it the edge over the competition. The EV companies built a diversified and integrated business model, spanning across different segments and markets like EVs, battery storage, and solar panels, software and insurance, and it's also got its own vertical integration strategy, enabling it to control supply chain production and distribution. These are a few reasons as to why Cramer is wrong about Tesla, and we won't be surprised when they're shocked by the amount of growth that Tesla can achieve in just a few years from now. But before we carry on, if you like this type of content, hit that like button, subscribe, and turn on that post notification to keep up to date on everything going on with Tesla. Tesla has a mission to accelerate the world's transition to sustainable energy, reduce greenhouse gas emissions, and fossil fuel dependencies. And Tesla stock is such a polarizing and controversial one, with a range of opinions and expectations from analysts and investors alike. While some are bullish and optimistic about Tesla's future, others are bearish and pessimistic. But you know what's interesting? That doesn't just stop Tesla's potential and true valuation. The automaker's shown that it can overcome any challenge and obstacle, and it can deliver on promises and goals. However, this undeniable fact, investors are still asking this one question, and that is if Tesla can ever reach its all-time highs again. This topic has raised a lot of controversies, so let's see the possibilities ahead. Tesla has a stock price that has reached an all-time high, sitting at $414.50 a share after rocketing more than 50% in a month. This stock performance was truly remarkable for a company that had only just begun to make a significant profit and revenue from its car sales. The Tesla stock momentum has been absolutely phenomenal, and we can't help but expect an even better stock performance for the rest of this year. Which makes us wonder whether or not Tesla can actually replicate its 2021 move again this year. What if Tesla stock doubles all time again before the end of 2024? Yes, this is pretty bullish, but before you dismiss this as more Tesla hype, let's evaluate some of Tesla's fundamentals together.
It's Tesla. The shares are jumping. We did have a batch of upbeat news driving sentiment on Wall Street, including a note from Morgan Stanley's Adam Jonas. Pras Subramanian's here with the details. And we were talking a little bit about this note earlier, but it's very interesting that he looks at this company, and I guess he has for a while, as bigger than just cars.
Yeah, beyond an auto company is what he's sort of saying. If there's a way to drive his bull case, I guess, for the shares of the company next year in 2024, looking ahead to things that are non-auto, non-core is what he says to the business. And it's funny because he mentions in the note later on that he has got significant pushback from clients about this, and he still, hey, you know what? No, I'm a true believer in this stuff. Like, for instance, Optimus robot, Tesla adjacent technology, tech that could upend the label market, Dojo supercomputer. We talked about this before. The supercomputer that can be used for any number of purposes like AWS, in that sort of a realm of possibilities for the Amazon's, huge EBIT mover with AWS. Also noting their edge AI. Imagine your car is a robotic edge AI device. Beyond just collecting information for, FSD, imagine the key for your car is a phone, for instance, a Tesla phone, right? Stuff like that. I also want to note the EV infrastructure kind of boost there. As GMs and the Fords of the world pulled back on spending, Tesla can step up on new spending for AI, for FSD, for their supercharger network, which they're using legacy OEMs for, that sort of thing.
And how much Pras is also the bullishness there, because is his bet also in part he's looking at rivals who are kind of pushing out these EV-related investments and saying, okay, that's runway for Elon Musk?
Right, as the legacy guys pull back, gives you an opportunity to push in and spend more and gain more market share in those Tesla car adjacent stuff, right? Software, supercomputing, and the EV infrastructure stuff like the charging networks we're talking about. That's sort of a big deal there. But I just want to note that it's funny because not funny, but it's his model for 2030 and beyond includes these services as being a huge factor in Tesla's profitability and revenue growth there. So it's something that we've seen other bulls like Dan Ives talk about that as well. It's just so far out that I think that's why clients are saying, hey, what about next year?
Well, next year he says auto margins are going to go down.
Yeah,
They're going to be lousy.
Potentially negative operating margin, which is that's first I've heard of that, but he's still noting that and saying, hey, you know what? Look to the long term, not just 2024.
All right.
Tesla's growth catalysts are the first thing to think about when you're writing a Tesla forecast. This includes analyzing demand for EVs in different parts of the world, in regions where Tesla has launched products and in markets where it plans to enter. Investors should also look at the competition and what these companies are doing for their vehicles in order for them to end up taking a piece of Tesla's pie in the future. In 2022, Tesla vehicles were in high demand, but amidst macroeconomic changes in the production of EVs, the automaker had a bit of a price hike. Tesla offered to cut prices in the US to juice demand, and so in 2023 as well, it slashed prices in China for the second time as competition there continued to mount. Fortunately, Tesla still has a few advantages over its rivals. It has established a large EV production footprint with 4 plants globally, while many competitors are still building their manufacturing capacity. Tesla cars are still doing very well in their own markets. According to Tesla, the Model Y was the best-selling passenger vehicle on Earth in the first quarter of last year. This vehicle was the best-selling non-pickup truck in the US in the first quarter, the best-selling SUV in China in the first quarter, and the best-selling vehicle of any kind in Europe in the first quarter. With Tesla production and sales expected to grow through the year, it's going to be tough for any other automaker to catch up with the Tesla model. The Model Y has constantly been one of the top-selling best 3 automobiles in the world, and it's led to the Model Y climbing 3 spots to number 1 globally, with more than 263,000 sales to open this year. Tesla Model 3 has also been pretty impressive. The Tesla model has annihilated its ICE counterparts in the reliability study from Germany. A new study from a German vehicle analysis firm, the ADAC, highlighted the reliability advantage, finding the Model 3 to beat out the vast majority of gas-powered vehicles.
Tesla stock still has a lot going for it heading into 2024. Our very own Madison Mills is here with the 3 big catalysts for the EV giant. Madison.
Guys, I still can't get over that soundbite we played earlier. They can't even get their own numbers right on this stage, not to pick on them again. But come on, you're saying that you're going to have 20 million in annual vehicle deliveries. This current year's upcoming target for 2024 is just 2 million. So a lot of aspirational goals, to put it lightly, for Tesla moving forward here. Now, having said that, to give them some positive news, guys, I didn't know this. 3 of the 5 biggest vehicle sales in 2022 were actually trucks. So the Cybertruck move for Tesla heading into 2024 could be the thing that saves them when it comes to some of that margin compression that they've continued to mention on their earnings calls. But the big question is the next-gen batteries for those Cybertrucks moving forward. Also, the ramp up in production of those Cybertrucks. They're expanding their factories in Mexico to allow for some of that production ramp up to continue, as concerns about that production volume remain on the street. Now, we also have anticipation of that $25,000 vehicle for Tesla coming in here in the next 6 months to a year. That could be a boon for this name if they're able to kind of expand their market share by allowing for a little bit more of an affordable name. But an affordable product is not always good news for margins. So I'm curious about how they're squaring that with their margin compression concerns that we've heard Elon continue to talk about. More long-term, though, guys, we've got the Dojo supercomputer and, of course, Optimus the robot. I can't not mention that. But the question is, these are long-term goals. It feels to me as fantastical as a self-driving car at this point. When am I going to see it? When am I going to be able to get in a self-driving car that takes me to and from the East Village on a Saturday night?
I'm an Optimus robot. So you're getting a demo real time.
Really?
Yes.
Is that why you're able to write on paper here that's actually a computer?
No comment, Brad, over to you.
You know, as we're thinking about Optimus, the 4680 battery, and then lastly, the Dojo, you talk about a reality check that might need to be had over at the company. They were talking earlier about this year, the Dojo being able to compete with the NVIDIA H1 by the end of this year. Now, we already have NVIDIA iterating on top and already talking about the A100 and the H100. So they're already, again, miles ahead of where the rest of the field, in whatever AI play they're trying to make, catching up with NVIDIA at this point in time here, too.
Aside from AI, Tesla is also taking a deep dive into AI. In November 2021, Cathie Wood described artificial intelligence as the next big frontier in the tech sector, and ARK believes that AI and its technologies can together perform to provide exponential growth in the future of the global economy. The firm predicted that AI training cost reductions continued at an annual rate of 70%. In perspective, the cost to train a large language model to GPT-3 level performance dropped to $450,000 in 2022, after being near $4.6 million in 2020. According to Wood, her firm's been working on AI for a while now, and she thinks that some of these things that are now getting into progress are just the beginning of the impacts that AI is going to have on every sector, every industry, and every company. In Wood's 2023 Big Ideas report, the investment expert stated that the market value of disruptive innovation platforms could scale 40% at an annual rate during this business cycle, from $13 trillion today to $200 trillion by 2030. Wood also further stated in the reports that in 2030, the market value associated with disruptive innovation could account for the vast majority of global equity market capitalization. AI is creating explosive demand for training data, and ARK estimates that the cost of training an AI model with 57 times more parameters and 720 times more tokens than GPT-3 would fall from $17 billion today to $600,000 by 2030. ARK's report stated that winners in AI are companies with high-quality domain-specific AI training data across vertical applications. It also stated that better and more sophisticated and specific data results and improved AI models will give rise to better products and thus attract more customers. ARK's prediction is that a 100% adoption is going to bring AI to the global market, with productivity around $200 trillion, compared to $32 trillion in total knowledge worker salaries. Cathie Wood is of the opinion that AI is going to converge with everything, blurring the lines between sectors and causing companies to cross over into each other's sectors. While Tesla's path to advertising may not be clear at the moment, it sure does have the potential to turn in more demand for the automaker. But what do you think? Let us know down below, and if you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there.